The economic tug of war continues to create volatility in the stock market. Thanks for checking out this week's Fastest 4 Minutes in Finance. I'm Scott Inman. Well, the hot start to the year for the stock market has cooled in the past couple of weeks. The reason? Investors are digesting good news as bad news and great news as even worse news. Let's explain. The January inflation report was released on Tuesday, and it came in a little hotter than expected. The U.S. Consumer Price Index rose 0.5% month over month and 6.4% year over year. The year over year number is slightly lower than the previous month, but not by much. For those of you watching the video version of the Fastest 4, check out this chart from LPL Research showing the inflation trend. The Federal Reserve preferred inflation rate is about 2%, and you can see the four major tracking measurements for inflation were close to that for about 8 years. The COVID-19 pandemic drove inflation down briefly as demand was shut off by the federal government shutting down the economy in 2020. Then the reopening sent off the current spike in inflation, hitting its peak last year, and now you can clearly see it's coming down. That is good news. It's just not coming down fast enough for the stock market. Investors saw that good news as bad news. They want to see that number fall faster because they want the end to the Federal Reserve rate hikes. The Fed has raised rates every meeting for the past year now in an effort to cool demand, which in turn is a hope to cool inflation. It seems to be working, at least in certain sectors of the economy. We all know the housing market has cooled because of higher mortgage rates. Embedded in this past month's overall inflation data was a drop of 11% in used car and truck prices. Medical services have fallen in 3 out of the last 4 months, but groceries, restaurants, and energy were all up. Now on Wednesday, retail sales data was released, showing a 3% rise, the largest one-month jump since March 2021. Big jumps were seen in auto sales, restaurants, electronic stores, and furniture outlets. The American consumer continues to spend money. Unemployment remains at a 50-year low. It is getting harder and harder to see a recession coming. In fact, economists at Goldman Sachs reduced their likelihood of a recession this year from 35% to just 25%. That's great news, but not for the stock market. The S&P 500 dropped when the retail sales data came out this week. The great news was seen as even worse news when laid against the backdrop of a rising interest rate environment. Higher sales means high demand, which could mean continued high inflation, which could mean a longer cycle of rate hikes. It is an economic tug of war, which really means business as usual for a long-term investor. You should always expect short-term volatility. Where we are headed in 2023 should not make much difference to an investor with a long-term plan built to be invested in equities for a decade or longer. Short-term volatility can be a big problem, though, for a near-term retiree if they're planning to utilize their assets as income. That plan should still be invested in equities too, but not for the assets needed for income in the near term. If you need a plan, a genwealth advisor is always available. Thanks for listening.